Welcome everyone to today's podcast. I'm your host, Christo de Wit, Country Manager for Luno, South Africa. It's tax season in South Africa, and as you gather your documents and prepare to file your return, you might be wondering, what about your crypto transactions? Do they fall under the same tax rules? Are you liable for taxes on your crypto holdings? Today, we're here to answer those questions. We're joined by some leading experts who will help demystify the world of crypto tax. Jashwin Baijoo, Associate Director and Head of Crypto Asset Compliance at Tax Consulting South Africa, Wiehann Olivier, Partner as well as FinTech and Digital Asset Lead for Forvis Mazars in South Africa, and Dale Russell, Director of TrustReserves Solutions Limited and Moore Blockchain and Digital Assets, Johannesburg. Now, every tax season, questions about tax liabilities spike in online forums, media, and even through our customer support channels. Some say that all regular tax rules apply to crypto, but even that isn't always clear in its application. Dale, are there any instances when crypto transactions are actually tax-free?
Christo, I think that's a great misconception that's currently held amongst users, is that you're going to get away with tax obligations that you inherently wouldn't get away with in traditional markets. And I think it's important for users to realize that this tax obligation steers relatively similar to other markets, where you've got a tax obligation pretty much at every point in time where there's a taxable event. So the idea of the income versus capital debate comes into play, and the certain treatment of specific events. But in a nutshell, there are no specific taxable events that are actually tax-free, and the guidance kind of shows us that it follows the typical rules of income tax and capital tax.
Now, there's a widespread misconception that crypto asset transactions are completely anonymous and untraceable. While the blockchain is a public ledger, making transactions pseudonymous rather than fully anonymous, it's crucial to understand that tax authorities like SARS typically rely on exchanges for transactions when determining tax liabilities. Wiehann and Jashwin, would you say that what would you say are some of the most common misconceptions about the taxation of crypto assets in South Africa? Wiehann, let's start with you.
I think from my side, the first misconception is summarized well in the sense that some people believe that transactions executed on a blockchain are private and anonymous, which of course is not the case. Blockchains are both immutable and transparent ledgers. So from an immutable standpoint, it means that any transaction recorded on the blockchain is there forever, even 100 years from now. And I think in addition to that, there's also this misconception that SARS will only go back 5 years to investigate transactions. However, if SARS believes that individual or company evaded tax, they can go back as far as they deem reasonable. The second characteristic that I mentioned is the element of transparency. It allows anyone to gain access to the blockchain to view a specific transaction. However, without the use of analytical tools, one cannot easily identify which transaction relates to a specific natural person or legal entity. And I think that's where exchanges effectively come in to assist with this transition from being anonymous to pseudo-anonymous due to these exchanges' implementation of KYC, know your client, and anti-money laundering procedures. Therefore, when tax authorities or the Reserve Bank want to follow a specific trail of transactions, they would usually have to request this from the relevant exchange to get a full comprehensive picture of the transactions associated with a natural person or a non-natural person. Now, I think fortunately, in South Africa, our crypto asset service providers are regulated, meaning that they must comply in providing information to these regulatory authorities, which, of course, I've witnessed firsthand in the past as well. And I don't think there is a crypto asset service provider in South Africa that will put their neck on the line in not providing these regulatory authorities with the information needed or requested, rather. So it's perhaps also worth mentioning that exchanges do not report to the tax authorities and the Reserve Bank in real time yet. So the process of requesting information and obtaining that information from the crypto asset service providers is still a fairly manual process requiring resources from SARS's point to investigate these ad hoc instances. I think another misconception relates to the triggering of tax events. I listened to a podcast a while ago where an individual made a comment about the movement of cryptocurrencies from an on-ramp where they've effectively bought a cryptocurrency to a self-custody solution, and that triggered a tax event. Of course, this is not the case. Digital assets will retain its form unless it's exchanged for another cryptocurrency or for fiat or for the payment of goods and services. So I think the fourth misconception relates to why cryptocurrency was created. Effectively, with the creation of Bitcoin, it was created to allow this peer-to-peer payment over the internet without this need for an intermediary. Now, there were, and I'm really hoping there's less people who believe that the development of cryptocurrency that falls outside of the boundaries of the digital financial services sector also means that it falls outside of the ambit of the tax law, which of course is not the case, as we'll discuss here in more detail today. So cryptocurrency is deemed to be a normal asset in terms of the Income Tax Act, and therefore it's something that cryptocurrency enthusiasts should always consider when entering into a specific transaction or engaging in a certain way, shape, or form. And it's therefore important that those investing, trading, and using cryptocurrencies do so such in a manner that is above reproach and in compliance with the Tax Act and exchange control regulations.
Thanks, Wiehann. And Jashwin, anything you'd like to add to that?
Yeah, so I mean, as the point of departure, we probably want to look at the fact that there's a misconception in the market that SARS have that open access to your crypto asset platforms. And taxpayers, and clients, especially for the platforms, need to be aware that it is currently a case of upon request, and unlikely it will ever get to that fully automated stage. So SARS have an automatic exchange of information with revenue authorities in other jurisdictions, as we all know. Now, the way the crypto access to information is more likely to go is very much similar to the financial institutions, where SARS file a request. The financial institution cannot say no. They're legally obliged to obviously submit that information, but per request and on request. Much the same as SARS can then issue a third-party appointment notice and extract funds from a taxpayer's account. And in terms of the biggest confusion, I mean, Wiehann mentioned it as well, it's that capital versus revenue item. And for crypto traders or crypto investors, as there is the differentiation, your biggest stumbling block is ascertaining what was capital in nature, what was revenue in nature. Do they actually consider the fruit versus the tree analogy? You're staking tokens, typically akin to trading stock in nature, always revenue, yet the staked CA itself is then an income generating asset. So if it were disposed at some stage, it would attract CGT rather than taxation at the individual's marginal rate. And then we do obviously have something to look forward to, which is SARS are working on a guide on cryptocurrency. How robust that guide will be is yet to be ascertained, but they did confirm it yesterday in our panel discussion at the SAIT tax indaba, that the guide is in progress. It will cover capital versus revenue, which is probably one of your key considerations. It will outline the filing requirements and how it's to be done. But again, like all guides, they've mentioned they're not issuing it in the form of an interpretation note or an explanatory memorandum. Merely a guide. It's a work in progress. It'll be a pilot. It'll be refined over the years, and that's basically where we are from a regulatory standpoint. And that then raises the subsequent question of, well, if they haven't issued a guide yet, why are they issuing audits specific to crypto-generated income when they don't have the framework within which to actually process that data?
I mean, I think it's a very necessary development, and this guide will definitely be a much helpful asset as we move forward in this space. But I think in lieu of that, that's the reason why we have this podcast. So let's dive into how different types of crypto investors are actually taxed. From long-term holders to active traders, your tax obligations can vary significantly based on your investment strategy. Now, Jashwin, will you help us break down the different types of investors and tax implications for each? Now, let's start off with long-term investors. A long-term crypto investor is someone who holds onto crypto asset for an extended period of time, anticipating long-term growth. These investors are generally taxed on capital gains or losses. Now, could you explain how long-term crypto investors are actually taxed? Perhaps drawing a comparison to the tax treatment of shares, a more familiar asset class.
So there is discussion of the holding. So you'll know with shares, there's obviously that 3-year rule, right, which determines it. Now, a share is typically acquired with the intention of holding it as a long-term investment. With crypto, it's a little bit different, and it is more of a factual inquiry than anything else. So yes, there is the acquisition with capital intent, which is all good and well, but it is then a case of what's your transactional frequency like? As Wiehann mentioned, if you're moving it from a platform to a cold wallet, as an example, that's not a taxable event. It's the same as, Christo, if you took money out of your current account, put into your savings account, and SARS say, hey, gross income times 2. And mind you, they're doing that, unfortunately. We've seen many orders. I see Wiehann having a good chuckle there. He's seen a good couple of those as well, where you've got to, detail, transaction by transaction, SARS, this is why you've duplicated, it's not gross income. And much the same with your crypto. So your differentiating inquiry is always factual, and it goes one of 3 ways actually. You've got, on the one hand, confirmation that, listen, this is an asset. By all means, you've held onto it for ages. You've never traded. There's been nothing. It's not even been staked. And then on the other hand, it's, well, you bought 5 Ethereum. You've transacted over the last 5 years with 2.5 of them. The other 2.5 has stayed. And then working on your first in, first out principle, you'd have an apportionment where half goes capital and half goes income. It's akin to trading stock, just based on your transactional frequency. And then on the furthest side, you've obviously got, you bought your 5 Ethereum and you've transacted with all 5 on and off on an ongoing basis over the last 5-6 years. Maybe 0.5 has retained its original characteristic from that first acquisition. But for the most part, it's akin to trading stock, and you would then taxed at your marginal rate under other income.
A very interesting point, and I think that leads into, if we look more specifically to traders or short-term investors or speculators, if you will, who frequently trade crypto assets, often disposing of them when opportunities arise to make a profit. We know how volatile the crypto market is. Now, these individuals are taxed on their entire crypto profits, deducting any allowable expenses at their normal income tax rate. Jashwin, how do you distinguish between a trader and a short-term investor, and when does one pay income tax on crypto transactions?
Yeah, so much the same. Very factual inquiry, and what we're finding is the distinction actually comes from, is this your main course of trade, or is this a secondary course of trade that maybe started as a hobby and now has grown into something more? Where it is your main course of trade, we would typically recommend actually a corporatization of those crypto assets to more easily be able to claim, and obviously be able to claim more deductions against any expenditure incurred in the production of income via that crypto. On the individual side, as much as it's all good and well to look at your 11A and say, listen, these are the deductions, getting those across the line with SARS is a very different discussion, and that may stem, and I think maybe Dale would be better to advise on this, but it may stem from them simply not understanding how the crypto transaction itself actually works and what goes into that.
I think if you've mentioned also the point around, and Wiehann also alluded to it, but a natural person versus a legal entity. At Luno, we allow customers to open up a business account to trade or invest in the name of a company. Could you explain when a company's tax rate applies and how the calculation of crypto tax might differ from that of an individual?
So the nice thing, and the reason we actually always advise some of the more high-flying guys to actually corporatize, is it's a 27 rate as averse to, in all likelihood, a 45 rate. So that's the first big benefit. But if we actually consider it to actually extract those profits then as dividends, you've got a knock on of that 20% withholding tax rate. So yes, it's 20 on the 100 minus the 27, which is a little bit less than the 45 overall cumulatively. But at the same time, when you're chatting to clients and traders and they're adding up these numbers, they're saying, listen, this kind of looks like a 47. So your key difference, one is your corporate income tax rate, which is your flat 27, versus your marginal rate, which can go right up to 45. In some countries, like the Netherlands as an example, there's a little separate disclosure, but like a wealth tax. So, but circling back to the South African specific side of it, you've got your flats on your 27 on the corporate side and a larger list of deductions that may be claimed. And then on the other side, you've got your marginal rate ranging up to a 45 with a reduced list of deductions that SARS are accepting currently. Rightfully or wrongfully, we're not too sure. They've kind of acknowledged that they do not have the capacity currently, which is why they are looking at privatizing certain complex financial transactions, which may very well include crypto and will most likely include crypto arbitrage trading, because that's one that really does baffle them quite a bit. And that's through their request for tender they issued about 2 weeks ago to enlist a panel of consulting firms to assist them with things like this and to also develop a risk compliance matrix within which they can operate across the board. From the factual inquiry, your factual inquiry is very much similar, but with a company. If the company was incorporated with the sole purpose of crypto transacting, in all likelihood, it is then the trading stock element that will prevail.
I mean, Dale, Jashwin put you on the spot there, but is there anything you would like to add to this conversation or to this point?
I think that it speaks to strategies around harvesting losses, utilizing of your donations or staying informed to only report on taxable events, the holding thereof. So I think it becomes very it comes down to how do you get across the line from almost like a contractual type basis, or not really. It's more case law where it's like, okay, you have to justify your case that you're sitting on a capital asset versus a trading asset, right? And inherently, everyone as an individual wants to lie in that bracket because you're sitting at a marginal income rate of 40% inclusion as opposed to the 47, because you've got your annual exemption and it's coming in at 18%. So that it becomes quite tricky. But I think if you just apply the simple, stay informed, stay above the law, and approach it with the risk in mind that a lot of this can go wrong quite quickly, is to follow the guidance as the regulator proposes.
Now, we know that crypto is more than just buying and selling. There are various other products and services, from staking to paying for goods and services with crypto. But how are these activities actually taxed? Wiehann will guide us through the tax treatment of these different crypto offerings, help us understand the nuances that come with each of these products. Now, Wiehann, let's start with staking. Staking allows you to earn rewards for helping to validate transactions on the blockchain. With Luno, you can also easily stake assets like Ethereum, Solana, and Cardano. Are staked crypto assets considered capital? And how are the rewards from staking classified for tax purposes? Are they subject to income tax? And what should stakers be aware of?
Yeah, so I think all in all together, I'm not too fond of using the word staking, as it sometimes can be a bit misleading from specifically from a tax point of view. Staking can be seen as instances where you receive rewards as part of the protocol for validating a transaction you mentioned. Could be where you provide liquidity to a smart contract or automated market maker, returning a liquidity token as a yield, or even lending cryptocurrencies for the purposes of receiving interest. Now, of course, as alluded to during the conversation, is to further complicate matters, SARS has not provided any authoritative guidance on gains received from staking, when gains are considered capital or income in nature. They merely stated that the normal rules apply. So the onus is still very much on the taxpayer to demonstrate to SARS that a certain asset is gains or capital in nature. So one could potentially argue that the capital invested for the purpose of generating a yield could be considered capital in nature due to the whole fruit and tree principle as discussed earlier. The tree, of course, being the capital asset, i.e. the capital used and invested to generate that staking reward, while the fruit is the income or the yield received from the specific transaction. Now, this cannot be viewed in isolation, as SARS will also look at the taxpayer's entire portfolio and the nature of the transactions that had been conducted by this individual and the nature of the specific transactions and asset holding. So therefore, a clear trading strategy must be implemented to counter any of these misinterpretations by SARS. So in summary, my view is that in most instances, yield received will be classified as income and taxed on a taxpayer's marginal tax rate, as previously mentioned. And I believe there could potentially be a case for proceeds on capital used to generate that staking rewards to be capital in nature as opposed to income, but that would require a thorough consideration. And therefore, I would highly recommend and suggest that those interested and engaging in these types of trading activities engage with a reputable and knowledgeable tax consultant and practitioner to make sense of it all.
And I mean, I think it comes down to where SARS mentions the normal rules apply, but in the realm of cryptocurrency, it's the language and the naming of these asset classes that differs, and therefore where a lot of the confusion stems from. Now, when you sell your cryptocurrency to buy another, is it considered a taxable event, even if the transaction doesn't involve converting it to fiat or to South African rand?
Yeah, so crypto to crypto transactions are seen as a barter transaction in terms of the Income Tax Act, therefore triggering that taxable event. So there is this massive misconception in the past that a taxable event is only triggered when cryptocurrencies are sold for fiat currency, which of course is completely false. So when you exchange your cryptocurrency for another, you need to consider the quantity and the spot price you actually paid for that cryptocurrency you're disposing of, and consider the FIFO method, the first in, first out method as prescribed by SARS. So you need to do this for each instance where you purchase and dispose of a cryptocurrency for another type of cryptocurrency, which can, of course, become extremely complicated based on the volume and the nature of the trades. Therefore, from my point of view, I highly recommend that traders use tools to track their transactions to assist with that accuracy and reporting into their income tax returns. I've had situations in the past that individuals weren't willing to pay 5,000 Rand for annual subscription of one of these tools, and they ended up paying in excess of that to their accountants to try and decipher and recalculate the tax obligation for South African individuals. Now, we're in the fortunate position that there are multiple tools out there, specifically looking at something like Ledger Tax that will be available later this year, which effectively links with the APIs of the various exchanges, including Luno and on-chain data, to effectively calculate your tax liability for a specific year of assessment.
And you mentioned, some taxpayers being unwilling to fork out the 5,000 Rand, but I also know of many of these services that go for far less than this. So it's a very good recommendation you make there. Something that we've been seeing of late is that people are starting to use cryptocurrency to pay for goods and services. I mean, using products like Luno Pay, paying with crypto has become so much easier. For example, at Pick n Pay, you can use your Luno app to scan a QR code at the till and pay for your basket of groceries with crypto. Wiehann, what are the tax implications when paying for goods and services with crypto?
So the entity providing these goods and services can price their goods and services either in ZAR, South African Rand, in US dollars, or in cryptocurrency. And there are two instances of how individuals can make these payments using cryptocurrencies. Merchants can either request a on-chain direct movement from one wallet to another, or they can use an intermediary such as Money Badger, previously known as Crypto Convert, and Luno Pay, of course, as you mentioned, which effectively sells your cryptocurrency for ZAR and then sends the ZAR to the merchant, such as Pick and Pay, because Pick and Pay wouldn't want to custody their digital assets. Well, of course, yet. But in both these instances, you need to look at the transaction holistically. And the taxpayer needs to record the value of the cryptocurrency that was originally acquired, which is used to make this payment. Again, highlighting that need for accurate recording of all of these transactions. So when you make that payment in the form of cryptocurrency, either through an on-chain transaction, you would need to consider the spot price of the cryptocurrency you're using to make that payment, and also the consideration of the network fee and transaction facilitation fee. To give an example, let's say, for example, I bought one Bitcoin for 100 Rand a year ago. And a year later, that one Bitcoin has appreciated in value to 120 Rand, but I haven't used it for anything. So effectively, what I have there is a unrealized gain. So when I use that Bitcoin to purchase for goods and services, or to pay rather for goods and services, that unrealized gain effectively becomes a realized gain, and that 20 Rand realization needs to be included in my income tax. And of course, the flip side will also apply if you're in a situation where the value of the cryptocurrency you purchase that you're using to make that payment has deteriorated in value. Now, I think another caveat that I just maybe want to put in there is individuals making on-chain payment through an intermediary or through on-chain or through an intermediary also needs to consider exchange control regulations. So we've seen this in the past. We've seen instances where individuals participate in arbitrage trading. So they use their single discretion allowance and foreign investment allowance as prescribed by the South African Reserve Bank and exchange control regulations, and they utilize everything. Now what they do is they make a payment for a foreign supplier of goods and services. Now, effectively, that could be seen as an externalization of capital or right to capital, therefore triggering that externalization event and possibly putting that individual in contravention of exchange control regulations. So it's always important to keep that top in mind if you are engaging with arbitrage trading, or at least keep yourself or give yourself a buffer to engage into these types of transactions without exceeding your limited thresholds as provided by exchange control regulations.
And Wiehann, I know some jurisdictions, I think Australia is an example of one, allows a certain threshold where the treatment of these transactions are exempt from tax rules applying. Is there any exemption like this present in the current SARS framework?
So I think what I saw in the past is also referring to the de minimis rule that we see in the States as well, where these smaller transactions and gains realized from these small transactions can be omitted from a taxpayer's tax return. However, in South Africa, we don't have that benefit. Once again, I want to say yet. Hopefully it swings that way and it encourages more people to use the asset class to make day-to-day payments. But unfortunately, in South Africa, we don't have that currently.
You also mentioned exchange control, which obviously refers to South African rand, controls on South African rand leaving the borders or foreign currency coming in. With that in mind, and with this globalized world that we're living in, many people are receiving payments in crypto, whether for services or as a salary, and it's becoming more common. What are the tax application when accepting payment in crypto?
So you're 100% right. We've seen more and more of this happen recently, where individuals are based in South Africa, and because of the fact that we have cheap labor, foreign companies are willing to employ South African individuals working remotely, and they are effectively being paid in unbacked cryptocurrencies such as Bitcoin on Ether, as well as fiat-backed stablecoins. Now, I think before we unpack this, I think it's first important to understand that you as the African resident, as an African tax resident, is taxed on a worldwide basis, meaning your remuneration doesn't, let's rather say like this, if you receive remuneration from a South African source, it doesn't mean that that's just going to be taxed in South Africa. If you receive remuneration from a foreign source and you're a South African tax resident in South Africa, you will also be taxed on that foreign remuneration as well. So individuals receiving remuneration in the form of cryptocurrency would effectively have to go and say, well, on the earlier of the income or accrual, let's see what the spot rate was. So an individual, let's say, for example, using receiving one Bitcoin as a form of his or her remuneration would effectively need to go and see, well, go to CoinMarketCap, look at what the US dollar spot rate was on that specific day, convert that to South African Rand, basically using something like the Reserve Bank exchange control regulations, and then, the Reserve Bank spot rates on a daily basis, and then recalculate their tax obligation from that point of view. But once again, I want to emphasize that there needs to be thorough records of this, because when you convert that cryptocurrency to fiat, or you buy another cryptocurrency with that remuneration that you received originally in the form of cryptocurrency, or you pay for goods and services, it will trigger a secondary tax event. So effectively, if there was an increase and a decrease of value, sure, you would be taxed on that remuneration, but you would be taxed again if you use it for whatever purposes. So that's why it is so extremely important to keep accurate record of it. I think another consideration of individuals receiving remuneration in that form also has an obligation to register for provisional taxes, because these foreign businesses making these payments to South African individuals are not currently registered for pay-as-you-earn in terms of the Tax Administration Act, meaning that they're not withholding tax on a monthly basis when they're paying your remuneration as they would see in normal terms when you're receiving a salary. So that's definitely something to consider as well for those individuals receiving remuneration in unbacked or backed cryptocurrencies.
Crypto tax can seem so overwhelming, but I think what we've made clear is with the right knowledge, you can stay on top of your obligations. Dale will provide some insights into calculating your tax and even some strategies to reduce your tax liability legally. Now, the tax on crypto in South Africa varies based on transaction type, the applicable tax rule, and your income level. Dale, could you clarify how much tax South Africans should expect to pay on different crypto transactions?
Yeah, thanks, Krista. I think this has been covered quite a bit in today's discussion, but we're looking at individuals that are taxed on a marginal tax rate from 18% up to 45 on a tax bracket of your gross income. You've got capital investors, which is could be still an individual that has an inclusion in their income at 40% of the annual exclusion of 40,000, which they can deduct and include into their income tax return, which is significantly low, normally sitting at about 18%. I think something that hasn't been mentioned that's quite important is that you have different classifications of inclusions and exclusions, which is often misinterpreted. So, for example, mining is excluded from certain regulations from a financial services provider aspect, but the rewards from mining are still considered income for tax purposes, and that's something that's often misconceived by users. Is that I'm trading in NFTs because it's not a financial product for purposes of FIC or FSCA. That means that whatever rewards I get on that are not included in my taxable income, which is false. Any remuneration earned on mining or the sale of any cryptocurrency is included in your taxable income. So I think that's something to remember. And again, as both gentlemen have said, is always consult with someone. It can get a bit hairy, and you'd rather be paying for quality services than a higher obligation.
And I think while you can't completely avoid crypto taxes, there are several legal strategies you can use to plan your taxes and reduce your overall liability. Dale, could you guide us through some of these strategies, such as harvesting unrealized losses, utilizing tax rebates, and other legal steps to lower your crypto tax burden?
Sure. So I think these types of strategies must be carefully implemented when approaching your taxable or your tax return. You spoke about tax harvesting losses. So here, I think this is when you have an asset that's declined in value, and you obviously you have a sale of this asset at a lower value, and then you offset that loss and buy it at a lower cost, right? I think the most important thing about South Africa is we don't have that wash sale rule like in other countries. So you can offset your capital gains and losses, but I think it's important to realize that if not implemented correctly, you can find yourself in a bit of hot water. I think one of the strategies that's clearly outlined from this conversation is having a longer term view on this. Normally burns a shorter sort of taxable income per year. But remember, if you don't structure this, and I think, Jashwin, when you spoke about corporatizing this, it's using the various structures of trusts, etc., to possibly lower this in the longer term. And as we evolve and as we grow and walk into this more regulated space, possibly, if you have that longer term view, you'll be able to corporatize this in a very effective manner, as opposed to trying to trade the shorter term now at a marginal higher rate. But as we grow and evolve, we could be able to put this in a trust structure where you're deferring your tax consequences on the shorter term, which we could see evolve as we go along with the regulator. I think it's also important to know that your normal exemptions, etc., still apply. So you've got your annual CGT exemption, you've got your rebates on foreign credits. I think that's something else. You've also got things like your donations allowance. You've got strategic tax-free investment vehicles. So these are all things that mustn't be forgotten in the process of filing your return. I think everyone's so focused on these big transactions and these big. Often it's always a case of you get the call from someone who's waited too long to get there, right? And now you're trying to clean everything. It's all about planning, as you said. You got to look towards the future, not try and put your blinkers on and pretend like the regulator can't go back and come and collect from historic balance. So I think it's more of a acceptance and moving forward in strategy to say, okay, let's look at the longer term and let's play within the realms we're allowed to, and let's try and be tactical about how we approach this from a tax perspective, as opposed to trying to get around it. And I think that comes with maturity and adoption, and as institutional money comes in.
Yeah,
I think
just to expand on that, is obviously rectification of the historic stuff. So yes, we've got to plan long term, but what we find, and obviously again, this is due to the lack of guidance from SARS or SARB, etc., is a lot of guys they're feeling the pressure now and they want to come clean, and it's very important for anyone listening in here to actually know, listen, there are ways to do it legally. You've got the VDP, market volatility. SARS do cater for that as well. They provide debt relief in some instances if your asset has tanked completely, but your bill is still due, things like that. And all of those, as Wiehann has been mentioning, those are legal applications. You need to run them probably through a tax attorney. But there is some light at the end of the tunnel, and obviously your historic or current non-compliance or any discrepancies needs to be rectified before you can start planning your future.
I think, Jashwin, you also make a valid point there in terms of the VDP, and maybe just to address another misconception on that point is there's a lot of people think, I'll follow the route of a VDP if I get caught or someone from SARS starts asking questions. But as soon as that investigation effectively starts, the VDP is off the table. So there's no VDP in correcting historical information if they start that investigation. So it's best to get a jump on it as soon as possible. I think the long and the short of it just comes down to planning. I think as Dale mentioned as well, everything is up to planning. And I mean, from a personal perspective, also being a chartered accountant, I looked at reconciling my tax trading and whatever the case may be, and I just decided I'll just hodl rather, because it's just too encumbersome with all the record keeping that needs to be kept up to date, especially for those individuals engaging in bot trading as well. If you don't have reports from that bot trading, you're going to be in a hell of a lot of trouble in terms of reconciling that back to a tax liability.
This has been a great discussion, especially around, busting some myths and misconceptions. And I think as we have more of these conversations around providing clarity on the tax implication of cryptocurrency, I think more people will feel that they are well informed and make the right decisions. As a way of departing, I think I want to go around the room and then maybe just ask you guys, if what is your number one tip of remaining compliant with your tax obligation in crypto, and any other suggestions you might have. Wiehann, let's kick off with you.
Yeah, I think I've been quite vocal today in terms of the record keeping aspect of it. So that is, to me, the most fundamental principle that you can follow when holding long term or investing. It is just accurate record keeping. But twice I've alluded to something else in relation to exchange control regulations. And crypto traders have been so focused on the tax obligations and not looking at exchange control regulations. This is something that the South African Reserve Bank is looking at more actively. And I've seen this in practice as well. It's best to make sure that in all circumstances, you know what the requirements of exchange control regulations are, and you stay on the good side of that exchange control regulations. Because if I'm brutally honest, you don't want to get into a fight with the South African Reserve Bank. It is messy. So that's the two topics that I'll leave you with for today.
Jashwin, over to you.
Yeah, so definitely on the South African Reserve Bank, and what we've seen practically is when we apply for those approvals for international transfer for crypto trading, because you've got to declare the purpose and the source. That's when you get the most requests for additional information. So that's when they are the most sticky. And then on the SARS side, it's just a case of keeping the accurate records, absolutely essential. Lots of legislation speaks to 5 years, but as Wiehann mentioned earlier in our discussion, SARS can, and there's a very sneaky little provision in a lot of your sections in the tax laws that say at the commissioner's discretion. So when that discretion is exercised, it can suddenly be a 10-year, a 15-year, 20-year audit. So your documentary evidence is very important. And then lastly is to always maintain proper, accurate, and transparent tax compliance. At the end of the day, even when we're looking at future planning, whether it's for wealth preservation or generation, whether we're going trusts or offshore companies or fancy structures, it all starts, and your foreign authorities will request it. Please submit the tax clearance letter or the PIN for the individual that is the ultimate beneficial owner when you file your UBO registers. So that is absolutely essential, or even with the best planning, that structure will fall foul at some stage and crumble.
Dale, any final thoughts from your side?
Yeah, I think this has been a productive discussion. I think the main thing is always to consult sooner rather than later. So if you are unsure of something, if you are 50-50, if you are even 80-20 about a certain transaction, a certain treatment, I think the quicker that you consult, the quicker it gets resolved, and the lesser the implication is. So the first thing is not to be worried to consult with someone immediately. Even if you are concerned, it's a quicker remedy to getting compliant. I think we've seen how the wait and see approach has burnt people, and we encourage you to reach out to anyone who you believe is reputable. And it's quite evident from this discussion, you can see that there is expertise in South Africa to assist you. So I think fast remedy and accurate record keeping is two most important things. And again, to see the whole realm of not just income tax, there's so many different spheres that can be implemented and affected by a transaction across the various regulators, as highlighted, is that you've got to stay compliant across the board, not only in one bucket.
That wraps up our discussion on crypto tax in South Africa. A big thank you to our expert panel, Jashwin, Wiehann, and Dale, for sharing their valuable insights. We've covered everything from common misconceptions to specifics of how different types of investors are taxed, even how to approach your tax planning strategically. While crypto tax might seem complex at first glance, I hope today's podcast has helped demystify some of the confusion and provided you with more clarity. Remember, staying informed and compliant is key to making the most of your crypto investments. Thanks for tuning in, and happy tax filing.